Most people spend decades deferring taxes and call it smart planning. What they do not realize is that deferral is not a strategy, it is a delay, and eventually the IRS collects with interest. This video is about Roth conversions. Specifically, it is about a window of time that exists between when you stop working and when the government forces you to start pulling money out of your pre-tax accounts. That window is often 5 to 10 years long. Inside that window, you have a rare opportunity to move money from taxable territory into tax-free territory at the lowest rates you will see for the rest of your life. Most people let that window close without touching it. The ones who use it can save $60,000, $80,000, or more in lifetime taxes, not in theory, in real documented dollars. Here's the part your old advisor probably never explained clearly. A traditional IRA or 401k does not eliminate taxes. It postpones them. Every dollar sitting in that account has never been taxed. The IRS is your silent partner in that account, and that partnership does not end at retirement. It ends when you take the money out or when they force you to. The forcing mechanism is called the required minimum distribution. Starting at the applicable RMD age under current law, the IRS compels you to withdraw a percentage of your pre-tax balance every single year, whether you need the money or not. Those withdrawals are treated as ordinary income. They stack on top of Social Security. They can push you into higher tax brackets. They can trigger surcharges on your Medicare premiums, and they can cause more of your Social Security check to become taxable. The people who understood this early started shifting money out of those pre-tax accounts before the RMDs arrived. They paid a modest known tax rate now. They avoided a larger forced tax rate later. That is the Roth conversion trade, and it is one of the most powerful tools in retirement tax planning when you use it at the right time. Let me be direct about who this is for. If you are between 55 and 72, have a few $100,000 sitting in a traditional IRA or 401k, and you have not yet started taking required minimum distributions, you are exactly the person this video was made for, because right now, before those RMDs begin, you still have control. Once they start, a lot of that control disappears. A Roth conversion is not a product. It is not something you buy. It is a transaction. You move money from a traditional IRA or 401k into a Roth IRA. The IRS treats the amount you move as ordinary income in the year you convert. You pay tax on it now. In exchange, that money grows tax-free inside the Roth, and qualified withdrawals later are completely tax-free. No income tax, no Medicare surcharge impact, no Social Security taxation trigger. There is no income limit on conversions. Roth contributions have income phase-outs. Conversions do not. Whether you earn $60,000 a year or $200,000 a year, you can convert. That distinction matters because a lot of people were told they make too much for a Roth. That may be true for new contributions. It is never true for conversions. There is one critical rule to understand on the 5-year clock. Qualified withdrawals of earnings from a Roth are tax-free if the account has been open at least 5 tax years and you are 59 and a half or older. Each separate conversion amount also has its own 5-year window before its earnings can come out penalty-free. If you are already over 59 and a half when you convert, that second rule is less of a concern in practice, but it is worth knowing. The 5-year clock on the account itself starts with your first contribution or conversion, so the earlier you open the Roth, even with a small amount, the earlier that clock starts. One more thing on the mechanics before we go further. When you convert, you want to pay the resulting tax bill from outside the IRA, from a savings account, a brokerage account, cash on hand, not from the IRA itself. Here is why that matters in dollars. If you convert $50,000 and let the IRA withhold taxes to cover the bill, you are actually converting less than $50,000 into Roth status. You are converting maybe $38,000 while paying $12,000 in withholding portia, and that $12,000 never gets the benefit. Pay from outside the IRA, and the full $50,000 grows tax-free. At a long-term average growth rate near 10%, that $50,000 can become $120,000 or more over 15 to 20 years. And every dollar of that $120,000 comes out tax-free. That is the compounding benefit that makes paying the tax upfront worth it. This is the concept that changes the entire picture for most people near retirement. The gap years, the period between the day you stop earning a paycheck and the day your required minimum distributions begin. For many people, that window is 5, 7, even 10 years long. During that stretch, your taxable income is at the lowest point it will be for the rest of your life. You are not earning a salary. You may be delaying Social Security to let it grow. Your investment income may be modest. That temporary low-income environment is the opening. Because Roth conversions are taxed as ordinary income, converting during low-income years means you are filling lower tax brackets. You are converting at 22% or 24% instead of the 32% or higher that RMDs might eventually force on you. The math rewards you for acting inside this window and penalizes you for waiting until the window closes. A typical middle-class couple with $600,000 in traditional IRAs might reasonably target annual conversions of $30,000 to $70,000 during those gap years. The goal is to fill, but not overflow, their current marginal bracket. You convert right up to the top of the 22% or 24% bracket and stop. You do not spill into the next bracket up. You repeat that process every year the window stays open. Over 5 or 6 years, you can move $300,000 or more from pre-tax to tax-free status while staying in a bracket that feels manageable. That final number deserves emphasis. A multi-year strategy that shifts $300,000 from pre-tax accounts into Roth during these low-income years can avoid $60,000 to $80,000 or more in lifetime taxes. Not by doing anything exotic, by consistently doing one simple thing, converting up to the bracket ceiling each year while the window is open. Let me show you what the alternative looks like, because a lot of people decide to skip the conversion and just let the money sit. It feels safe. It feels like the responsible choice. It is not. When you leave a large pre-tax balance alone and let it compound untouched, you are not avoiding taxes. You are growing a larger tax bill at the same rate your account grows. Here's how that plays out in real numbers. A retiree with a $600,000 traditional IRA who converts nothing over a 10-year gap period could see that balance grow to well over $1 million by the time RMDs begin. At that point, the IRS mandated withdrawal percentage forces out roughly $40,000 to $60,000 per year in taxable income, so every year, whether the retiree needs it or not. At a 22% federal rate, that is $8,800 to $13,200 in annual federal tax on income that was never requested. Stack on state income tax, and the number climbs further. Now add the Medicare layer. The IRS is not the only system watching your modified adjusted gross income. Medicare uses a 2-year look back on your MAGI to set your Part B and Part D premiums. When your RMDs push that number past the IRMAA thresholds, your Medicare premiums jump, not by a small amount. A couple whose combined RMDs breach the first IRMAA tier can pay several $100s more per month per person. That can exceed $3,000 extra per year just in premium surcharges because their pre-tax balance was too large. The retired nurse who came to understand this did not have an unusually large IRA. She had a modest one, just large enough that when combined with Social Security, her projected RMDs pushed her over the first IRMAA threshold. She was on track to pay thousands of dollars per year more in Medicare premiums for the rest of her retirement, simply because no one had shown her how to reduce the balance before distributions became mandatory. A 3-year conversion plan, staying inside the 22% bracket each year, eliminated that premium exposure entirely. The Social Security piece is just as damaging, and almost nobody talks about it clearly. Up to 85% of your Social Security benefit can become taxable income depending on your combined income level. When RMDs arrive and push your income up, they pull more of your Social Security check into the taxable column. So the tax cost of a large traditional IRA is not just what you pay on the RMD itself, it is also the additional tax triggered on income you were already receiving. Roth withdrawals do not count as income for this calculation. They do not count toward IRMAA. They do not push Social Security into taxable territory. Once the money is in a Roth and qualified for withdrawal, it is invisible to every income-based threshold in the system. That is not a minor detail. For a couple receiving $40,000 per year in combined Social Security, keeping RMDs low enough to avoid pulling that income into higher taxation can preserve thousands of dollars every single year. Skeptics of Roth conversions often say the same thing. Why pay tax now when I can pay it later? It sounds rational. It is wrong for most people in the gap years, and the break-even math shows exactly why. Take the conversion example from the research. A $50,000 conversion in the 24% federal bracket costs $12,000 in federal tax in the conversion year. If you pay that $12,000 from a taxable account, not from the IRA, the full $50,000 goes into the Roth. Compounding at a long-term average near 10% annually, that $50,000 becomes roughly $120,000 over 15 to 20 years. Every dollar of that $120,000 is tax-free on qualified withdrawal. Without the conversion, that same $50,000 stays in the traditional account, grows to $120,000, and is fully taxable when withdrawn. At a 24% rate, the tax bill on the way out is nearly $29,000 a year, more than twice what the conversion cost up front. That is a single $50,000 conversion. Now, run a multi-year strategy converting $40,000 to $70,000 per year across 5 or 6 gap years, staying inside the 22% and 24% brackets, paying taxes from outside the IRA each time. The cumulative shift into Roth status reaches $250,000 to $300,000. Modeled against no conversion, the net after-tax wealth difference over the full retirement horizon lands in the range of $60,000 to $100,000, depending on assumed returns and future bracket behavior. That range is not exotic. It is what a disciplined, methodical gap year conversion strategy produces for an ordinary middle-class household. The engineer who ran this calculation himself described the moment he saw the output as clarifying. He had spent years thinking of the conversion tax as a pure cost. Once he modeled the tax-free growth on the far side and compared it to the forced, taxable, bracket-compressing RMDs he was otherwise heading toward, the $12,000 upfront cost looked entirely different. It was not a cost. It was a purchase of tax-free status on a balance that would keep growing for the next 2 decades. There is one scenario where the numbers get even more important, and it is one most couples never think to model until it is too late. When one spouse dies, the survivor does not automatically get to keep filing as married filing jointly. They file as single. And single filers face the same dollar thresholds as married couples, but in brackets that are roughly half as wide. The same income that sat comfortably in the 22% bracket for a couple can land solidly in the 32% bracket for the surviving spouse. The same RMDs keep coming. Social Security does not disappear. The income does not shrink. But the brackets compress dramatically. A widower with $60,000 in annual RMDs discovers that income now sits in a completely different tax position than it did the year before. If the traditional IRA balance was never reduced through conversions, the surviving spouse inherits both the income and the full tax burden for potentially 15 or 20 more years. A Roth conversion strategy executed during the gap years directly addresses this. Every dollar moved from traditional to Roth before one spouse passes is a dollar that no longer generates forced taxable income for the survivor. The widower who watched his tax bill spike after his wife passed understood this viscerally. Had they converted $40,000 per year across 5 earlier gap years, the RMD load entering his single filing years would have been meaningfully smaller. The conversions they did not do became the tax bill he paid alone. The same logic extends to heirs. A large traditional IRA left to an adult child is not a tax-free gift. Non-spouse beneficiaries who inherit traditional IRAs are generally subject to the 10-year distribution rule, meaning the entire balance must be withdrawn and taxed within 10 years of the original owner's death. If the balance is large, those forced annual distributions push the heir into higher brackets during their peak earning years. A Roth IRA inherited under the same 10-year rule produces tax-free distributions instead. The adult child helping a parent plan for long-term care who discovers this often realizes the conversion is not just about the parent's taxes. It is about what the family ultimately keeps. Everything covered so far assumes that today's tax brackets hold. They may not. Current individual income tax rates were set by legislation that includes a scheduled sunset provision. When that provision expires, rates are set to revert to their prior higher levels. The 22% bracket could return to 25%. The 24% bracket could return to 28%. The 32% bracket could push back toward 33%. That is not a political prediction. It is the current law on the books. If the sunset occurs on schedule, every dollar you convert at today's 22% rate and did not convert before the deadline becomes a dollar taxed at a higher rate later. The window for historically favorable conversion rates is not open indefinitely. It has a likely closing date written into existing statute. This does not mean panic converting everything you own before a deadline. It means that a methodical multi-year conversion plan started now is more valuable than the same plan started 2 or 3 years from now, because the rate environment you are converting into today is more favorable than what may exist in the future. The math that already favors gap year conversions gets even stronger if brackets rise. The skeptical engineer who ran his break-even analysis added the rate sunset assumption to his model. With brackets reverting to prior levels, the break-even point on his conversions moved earlier, meaning he recovered the upfront tax cost faster, and the long-term savings grew substantially. Same account balance, same conversion amounts. The only variable was the tax rate environment in the future. Higher future rates made the case for converting now more decisive, not less. Roth conversions done without attention to the thresholds can create new problems while solving old ones. There are 3 traps that catch people who execute conversions without modeling the full income picture first. The first trap is IRMAA. Medicare calculates your Part B and Part D premiums based on your modified adjusted gross income from 2 years prior. A large Roth conversion in a single year raises your MAGI for that year. 2 years later, Medicare uses that elevated number to set your premiums. A couple whose combined income, including the conversion, crosses the first IRMAA tier, pays several $100s more per month per person. That can exceed $3,000 in extra annual premium costs, and it applies to both spouses simultaneously. The fix is not to avoid converting. It is to size the conversion so your MAGI stays below the first IRMAA threshold for your filing status. For a married couple, that threshold sits at $206,000 under current parameters. For a single filer, it is lower. Know where your baseline income lands before converting, and size the conversion to keep the total below that line. Spreading the conversion across multiple years is almost always preferable to a single large conversion that triggers both a bracket jump and a premium surcharge. The second trap is the net investment income tax. At a 3.8% rate, this tax applies to investment income, dividends, capital gains, interest when your MAGI exceeds $200,000 for single filers or $250,000 for married couples filing jointly. A Roth conversion does not directly generate investment income, but it does raise MAGI. If your investment income is sitting just below the threshold and a large conversion pushes your MAGI over the line, that 3.8% surcharge activates on your investment income. The conversion itself did not cause the NIIT, but it created the conditions for it. The third trap is the one already covered but worth restating plainly: paying conversion taxes from inside the IRA. If you allow the custodian to withhold taxes from the IRA to cover the conversion bill, you are converting a smaller amount into Roth status than you intend. Every dollar withheld for taxes is a dollar that never reaches the Roth. It does not grow tax-free. It does not compound for 15 years. It disappears into the tax payment and generates zero future benefit. Pay from outside the account every time without exception. The pro rata rule is the fourth trap, and it is the most technical. If you have multiple traditional IRAs and one of them contains after-tax contributions, money you put in without a deduction, you cannot simply convert only the after-tax money to avoid taxes. The IRS requires you to treat all your traditional IRA balances as one combined pool. The taxable and non-taxable portions of any conversion are calculated proportionally across the entire pool. If your total traditional IRA balance is $200,000 and $20,000 of that is after-tax contributions, then 10% of any conversion is non-taxable and 90% is fully taxable, regardless of which account the money moves from. This matters because it affects how much of a conversion is actually tax-free. People who assume they can convert their non-deductible IRA contributions without a tax hit often discover the pro rata calculation creates a larger taxable amount than expected. Know what is in all your traditional IRA accounts before you convert and run the proportional calculation first. A Roth conversion strategy does not require a financial advisor to design. It requires 4 inputs, a tax calculator, and the discipline to execute the same plan each year until the window closes. Start with your baseline income for the year. Social Security, if you are already receiving it, any part-time earnings, dividends, interest, capital gains from a taxable account. That is your starting point. Subtract that number from the top of your current marginal bracket. The difference is the maximum you can convert this year without spilling into the next bracket up. Then cross-reference that number against your IRMAA threshold. If the conversion amount would push your total MAGI above the first IRMAA tier, reduce the conversion to stay below it. In some years, the IRMAA ceiling is the binding constraint rather than the bracket ceiling. Let whichever limit is lower set your conversion cap for that year. Repeat this process annually. What? Each year you convert reduces the traditional balance and slows the compounding of the future RMD. After 5 or 6 years of disciplined gap year conversions, the projected RMD at 73 is meaningfully smaller. And so is the forced taxable income that would otherwise stack against every other income source you have. One detail on the December 31st deadline. A Roth conversion must be completed by December 31st of the tax year for it to count in that year's income. There is no extension. Unlike an IRA contribution, which can be made up to the April filing deadline of the following year, a conversion executed on January 2nd falls into the next tax year entirely. If you are planning a conversion, execute it with enough time to confirm the transaction settled before year-end. The couple who discovered this too late, executing what they intended to be a current year conversion on December 30th, only to find the transaction did not settle until January 3rd, learned it the hard way. One business day pushed the income into the following year, disrupting their bracket management for that cycle. Execute early, confirm settlement, and do not leave it to the final days of December. Here is where this all lands. The conversion deadline, the bracket ceiling, the IRMAA threshold, the pro rata rule, none of it matters if you never start. The people who save $60,000 to $80,000 in lifetime taxes with this strategy are not financial experts. They are people who ran the four numbers, sized the conversion correctly, and repeated the process each year the gap window stayed open. That is the entire framework. Not complicated, not exotic, just consistent, disciplined execution of the same four steps while the low-income window exists. The window closes the moment RMDs begin or the moment tax law changes, whichever arrives first. Both have known timelines, neither waits. So here is what to do today. Pull up last year's tax return. Find your adjusted gross income. Find your marginal bracket. Subtract your baseline income from the top of that bracket. That number, whatever it is your starting conversion ceiling. Then look up the current IRMAA threshold for your filing status and make sure your total modified adjusted gross income, including the conversion, stays below it. If both numbers point in the same direction, you have your conversion amount for this year. Execute it before December 31st. Pay the tax from cash or a taxable account, and come back and run the same calculation next year. If this video clarified something your old advisor never explained, subscribe. There is new content here every day covering exactly these kinds of retirement tax decisions that the industry has no incentive to walk you through on its own.